Hi, I'm James Robinson, and this is my stock pick of the week. This is part two of my 5-part series on Raytheon, symbol RTX. This time we're going to talk about the company's operations. Operations to me are how good a job a company does at delivering goods and services to their customers, and how efficiently they're able to do that in terms of costs. So the first thing that I look at whenever I look at a company is gross margins, and I've actually done an entire video on why I think gross margins are so important. And I'll try and figure out how to put a link to that up above so that when you watch the video, you could, if you want, you can go to that. The gross margins for Raytheon are a little less than I typically would like. They're sort of middle of the pack. They're not bad, but they're not great. And typically I look for companies with great margins. When you look at this company's management, you look at this company's finances, you're going to see why I'm really buying this company. I'm not a super fan of the company's operations. They're not bad. They're just not home run worthy. They're not... If every company was like that, they wouldn't be investment worthy for me. But there's some things going for it. They're a major player in a major market. They've got products that are, you just can't do without them. If you're going to own airplanes, you're going to have some exposure to Raytheon's products. They do a lot of government work, which is big numbers, hard to get into, hard to compete with established government contractors. And while the margins are less, the government's going to pay you. So you take all that into account, and no company is perfect. Every company has weaknesses. And if this company's weaknesses are average, which is what they really are, then we can live with that because there's so many areas where their strengths are far above average. Obviously, what's happening with gross margins is only relative to its importance when you look at the company's earnings. You look at the company's earnings, effectively, they've gone up every year since, call it 2001. And they're up over $4 billion, just about $3.5 billion of earnings now. And then the earnings per share have gone up faster than that because they've been buying back shares. So the gross margins are pretty stable, and they've managed to convert those stable gross earnings into ever larger profits because their revenues are going up. So it's a solid company from that aspect, and one way I like them. Now, I got to warn you that when you look at this number, 2020 is almost certainly going to be atrocious relative to this. It's going to be the worst year, maybe in 20 years that this company has had. But that's a unique situation because of COVID. It destroyed the airline industry really badly, and that means that it's hurt their customers very badly. But you got to remember that those customers are going to be replacing planes because the new planes are so much more efficient. They're going to be doing repairs on planes that they keep, and those things are both income streams to Raytheon. So what I foresee happening is there's going to be deferred income for Raytheon. It's not the money's going to evaporate. You got to spend a certain amount of money buying new planes. You got to spend a certain amount of money repairing the components to planes, for example, and you're going to come back to Raytheon because you have Raytheon products in your plane. A Pratt & Whitney engine only lasts so long, and it needs a certain amount of repairs. It needs a certain amount of replacement parts, and so you have no choice. So this slide, again, is one of the reasons why I was willing to mitigate my concerns about the company's gross margins. The gross margins are relatively constant, but the net earnings as a percentage of revenue has been gradually growing. And it's gone from, call it 7.5% to, something north of 10%. They're now in the top 25% of companies in terms of converting net earnings to revenue, or converting revenue to net earnings. So that's pretty good. You can see that also the revenues have been going up, especially since 2014, pretty dramatically, and that has resulted in greater profits. So this company's before COVID was on a really good trajectory. It was also very expensive. I've been watching the company for quite a while, but due to COVID, again, we're getting these opportunities to buy companies we wouldn't normally get. We have to be patient a little bit to cash in. We may even have some more losses. The stock's down 11% since I bought it on Monday. I'm not panicking. I wish I'd waited till today, obviously, but you can buy it today because it's significantly lower than where I bought it. But long story short, again, you look at the revenues are going the right way, the earnings are going the right way. There'll be a dips here, but it'll recover. I always talk about the 4 or 5 taxes, the operational taxes. There are things that a business has to do to run, things they have to spend money on typically. And you like to see those costs as consistently low as possible, or at very least as predictable as possible, hopefully reducing over time as the company gets economies of scale. If the company is way out of whack in a number of these areas, it's almost impossible for them to be profitable because these taxes just exist in a business. So the first one is selling and general administrative. That's just the cost to do the administration of the company, to pay your salesmen, to market your products. And so you can see that this company is good, but not great. They're sort of in the top 25% in this category, but also since 2012, for selling and general administrative, the company has been getting better. So that's what you like to see, right? That the company is is pretty good, in this case in the top 25% of companies, but yet improving every year in one of these taxes. The second one, plant and equipment, that's not very good in terms of plants and equipment. You can imagine that Raytheon has extremely expensive plants that they have to maintain and equipment to make these planes and the components to planes, the avionics and the jet engines. You can imagine that's an extremely expensive production process. But having said that, since 2015, every single year the costs have reduced for plants and equipment as a percentage of assets. So the company is doing better and better in these two categories. They're not great. They're not, plants and equipment is actually poor, but you'll typically find that every company has some area where they have to spend a lot of money that other companies don't. And it's just due to the nature of their business. Again, if I can see those costs under control and getting better, I tend to give them a pass, because especially if the company has been growing profits while having these areas of high taxes or high operational taxes, if you will. So plants and equipment are too high. The profits keep going up every year, and the cost for plants and equipment for the last 5 years have been going down. I like that. In terms of the fourth tax, which is inventory, this is something that plagues retailers, for example, where they have this tremendous amount of inventory that's the only way to make money, and they have to turn it a certain number of times to make money. They've got cash tied up in inventory, which is money they can't return to the shareholders. There's loss factors, which is really expensive because the products simply become worthless. You know, what's an iPhone 6 worth? If you'd been stuck with the inventory of an iPhone 6, you're just stuck with it. When a new product comes out, every time a new iPhone comes out, the value of the old iPhone decreases. So any inventory you have on old products becomes less and less valuable. So we like to see very small inventories. And surprisingly, you know, just based on the products that Raytheon sells, they have almost no inventory. It's actually, I expected the inventory to be a lot higher in this company because you don't need to have very many jets waiting for delivery for you to have a lot of money in inventory. And I'd say jets, I mean jet engines. But they're not a problem. So one R&D is another area that I expected would be very, very high for this company, and it's not bad. I alluded in an earlier video, they have 60,000 engineers working for Raytheon. I mean, that's a mind-boggling number. All of those engineers got to get paid, and if they're not doing R&D, what are they doing? And yet they are, you know, it's less than 15% of gross profits. And by the way, again, going down every year since 2015, or going down generally since 2015. You're going to see that they're not in the top 50% of companies for R&D. That's because 50% of companies spend nothing on R&D. So if you spend anything on R&D, you're sort of on the wrong end of that. But this company's R&D it's consistent. They keep coming out with new products. People keep buying their products, and the costs are not out of line. So generally speaking, I'm very comfortable with the R&D cost for this company, which is very different than a drug company, right? Where you can invest billions and billions of dollars in a drug and find out it doesn't work and you're done. These guys are typically building jet engines, and it's incremental improvement. And so you're going to typically get some kind of return from the investment that you put into R&D. Interest payments, again, I like to see interest payments below about 20% of operating income. This is well below that. Interest payment as a percentage of operating income, again, since 2015 has been going down every year. So not a problem. And what you're going to see with all of this company, what you hopefully recognize with this company, is that in every one of these tax areas that I call them, operational taxes that I call it, basically they've all gone down since 2015. So for 5 years running, those costs are becoming less and less significant. We're buying the company today as if it exists today. And if we know that our costs are going to keep ratcheting down every year, it's a pretty good sign. The next slide is net interest. And so net interest looks at interest income and interest expense and offsets them against each other to give you a sense of where the interest is. This company has started to hoard a little bit of cash, and so it was starting to get some interest income. I mean, not a lot, $100 million, which on a company of this size isn't tremendous, but they're not paying a lot of interest either. So it's creating a nice situation where your interest expense has been decreasing again every year since 2015. Some of that is because the money we've been saving has been generating interest income, and part of that is because we've reduced some debt or reduced our carry cost for debt. So a summary of operations for Raytheon. So in terms of companies they typically invest in, this company is about average in terms of its operations. It's not spectacular. It has relatively low margins relative to companies that I like, although it's in the middle of the pack. But it has, other characteristics that are okay. But I think the company had a grade of about 2.8 or 2.9 in my operational category, and I typically don't like to invest in companies that are below about a 3. But this company is very cheap, and the other 2 categories are good enough that I was willing to overlook that. In general, though, a 2.8 or 2.9 is significantly above average, so it's not below average. This is not where I like to see it. Gross margins are acceptable, they're generally predictable, and they haven't inhibited the ability of the company to continue to make more money every year. Earnings and earnings growth have been excellent, although I expect 2020 to be a down year, both due to COVID and due to one-time costs related to the merger. Selling general administrative is acceptable and reducing. Plants and equipment is high, but it's reducing. It's been coming down for the last 5 years. Inventory and R&D are both really, really good for a company like this, as well as interest payments. And again, all of those are coming down over time. So long story short, the operations are not good enough that I'd get excited and buy the stock just because of the operations. They're also not bad enough to disqualify the company. And when you look at the other characteristics we're going to talk about in future videos, you'll see why I like the company so much. So having said all that, if you want real-time information on my trades, you want to see articles or videos that I like that other people put up, you can follow me on Twitter. My handle is @RobinsonStocks. I'd love it if you'd subscribe or like. Also, let me know where you're subscribing from, where you live, what city you're in, so I can put your dot on the map. Thank you very much.